And hello, everybody. Welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Interest rates are rising, the economy is recovering, and everybody who is holding on to high-yield bond funds, one of the most popular investments out there, is wondering, what should we be doing with them right now? That's a big, big topic. We're going to have the experts try to give you some answers. Steve Lapley is the U.S. head of iShares fixed income ETFs. Isaac Braley is the president of BTS Management. He trades high-yield ETFs for clients. And John Dobby, my old friend, CIO of Astoria Portfolio Advisors. Gentlemen, thank you very much. Steve, let me start with you. You oversee the iShares high-yield ETF. That's the symbol is HYG, biggest high-yield fund in the world, J&K, And the important thing here, I think, is what is going on with the fund flows for this? Are you seeing significant outflows, inflows? How are investors reacting to this higher yield environment?
Yeah, so HYG is a bit of a specific case within our suite. It tends to be a product that's used by institutional investors to make rapid adjustments in their portfolios. So last year we saw very significant inflows as risk on set in, going towards the end of the year. We've seen some outflows this year as some investors have taken money off the table. If you look at across our suite at some of our broader products, we've had inflows into, for example, our factor fund, HYDB. We've had flows into our broader high yield fund, USHY. So I think there's some segmentation in investor behavior, and you're starting to see people bifurcate in terms of holding period as well.
Yeah, most high-yield funds like yours, like HYG, are throwing off yield in the 4.5% range, I guess, right now. It's still fairly low for the risks that are involved here. What's your big picture view of high-yield investing right now? Are you giving any broad advice to investors? Because this is one of the most popular asset classes. It's one of the questions I get asked all the time. What should I do with my high-yield fund?
So, yeah, if you look at where spreads are right now, we certainly have come a long way since last spring. So we topped out last spring at around 1,100 basis points over Treasuries, and now we're back down to the, sort of low to mid threes, 300 range. So spreads have come in quite a bit. I think, the way you have to sort of look at this going forward is there's probably not going to be very much price return from further spread tightening. You're thinking more about income and carry off of that, and then you need to focus on what's happening with fundamentals. And so what we see right now, we see default rates starting to fall. They were in sort of the mid-6 range. Most of the street estimates have high-yield default rates falling to anywhere from sort of the low 2s to the mid-3 to 4% range. HYG's spread right now is implying a default rate of around that 4% range. Upgrades are outpacing downgrades right now in high yield. You're seeing improvements in fundamentals in terms of interest coverage, and even recoveries are starting to edge up. So if you're thinking about that long-term income carry trade, you have to believe that there's going to be a handoff from the current stimulus measures into longer-term growth in the economy, and that those fundamentals will persist and allow you to continue to earn that income.
All right, Isaac, you don't run a fund, but you do trade these high-yield ETFs. What's your view of the impact of higher rates on high yield? What are you telling your investors now, your clients now, and how are you trading these?
Yeah, I mean, we run funds and SMAs, and I think for us, high yield is our primary trading tool, and we're defensive right now. I think that what was brought up before about default rates is true. We do see a collapse in default rates this year, but it's been pretty frustrating as defaults have stayed around that 6.15 level, and normally they fall off a cliff as soon as the recovery starts to happen. So that's been tough because that's a 77% increase in defaults over the past 30 years or so. And then when we look at spreads that was just brought up, those mid threes, that's a nearly 30% reduction over what we're historically seeing. And then the bad part, the part that we need to watch very carefully is really the recovery rates, because it makes defaults look even worse than reality. If we look at our recovery rates right now, we've improved significantly, but we're around 21 to 22 cents on the dollar. And if we go back to even the Great Recession, that was 27 cents in the dollar. The only times we see numbers like this are more in the 90s correction and the dot-com. So there is risk right now. We do believe the fundamentals are improving, but one thing about high yields is really this rising star element. The Kraft Heinz of the world's now performing significantly better, acting very much like investment grade bonds. You have to go all the way down to triple C's to find the return you want.
So, Isaac, why are the recovery rates so crummy, 20%? Why are they so low?
Yeah, in so many of these areas, although people are perceiving this fundamental change, it certainly hasn't happened yet. And so even though people want to price these securities down and the spread's so tight right now, the reality is many of these companies are still suffering. They're waiting for consumption to come back. They need that. And so the Federal Reserve will have to look at how they play that game, but also, in the end, consumption to generate cash flow for these companies.
Yeah, that's not a good sign. John, you have not been shy about telling clients what you think about this. Avoid bonds like the plague due to inflation. You wrote that to me this morning, but I've known you feel that way for a while. Does that also go for high yield right now? What are you telling your clients about high yield?
I think high yield credit is one of these things like you go to a restaurant and you look at a menu and something looks good, you order it, and then you get the food and you're like, why did I buy it? There's like a lot of risk, and I don't think you're being compensated for that risk for high yield credit. Like we're not an insurance company. We don't have like liabilities that we're trying to, match with, a certain type of yield. We're looking for the best return per unit of risk. And at the end of the day, interest rates are the ultimate equalizer because all asset classes compete with one another. So, are you going to put your $100 and buy high dividend yielding stock? Are you going to buy high yield credit? Are you going to buy, some physical real estate? Or, you want to search for the best return per unit of risk. And when I look at high yield credit, okay, fine, you're going to get, 5% yield, but your total return is not that attractive. And then anytime you get a recession, you can lose 30% on HYG or any type of high yield credit fund. So, you get all the downside, but not a lot of the upside. So you'll just never convince me that you're better off owning high yield credit compared to like a high dividend paying stock or an ETF. So if you look at the SYD, the Spiders Dividend ETF versus HYG, over the last 10 years, you basically get double the compound annual growth for SDY compared to HYG. Yes, it is a higher risk level, but it more than compensated. So the risk-adjusted return or the Sharpe ratio is higher. So I just think there's a better place to put your money. Our big view, Bob, is that, 10 years is going much higher. I think it's going to be closer to 3% where this thing goes. We're just printing money, and, there's just a ton of supply out there, and I don't see anyone looking to step in and buy these bonds. So,
John, if the 10-year goes to 3%, isn't high yield? High yield isn't going to sit at 4.5%, is it? I mean, high yield is going to go to 6 or 7, isn't it? Do you think the spread is going to change if the 10-year goes to 3%?
Well, I mean, I'll let Steve chime in on that. Steve's the expert, and I've known Steve for a while, and Steve's very, very smart. But for me, it's like, okay, if you can get 3% risk-free rate, and even, if the high yield credit is, 5-6%, like, is it worth taking all that risk when you can get, 3% on the 10-year? And still, at the end of the day, I'd much rather own, some high dividend paying stock that over time can increase their dividend to catch up with the inflation, right? And last time I checked, bonds don't increase their coupons. Yeah.
Steve, what about that? I know you're not a portfolio manager, obviously, so you don't have to. I'm not asking you to defend anybody's position on that, but it is a point. If yields go to 3%, if the 10-year goes to 3%? Excuse me. What does that mean for high yield, and does that make other assets a lot more attractive on a risk-adjusted basis? He was suggesting high dividend stocks. I don't know. First of all, is it your base case, or is it BlackRock's base case that the 10-year could go to 3%? And again, I'm not trying to ask you to act like a portfolio manager. I know you're not. You manage the funds, but what's the base case here?
I think by and large, we think rates will be reasonably contained. You know, they've come a fair amount since the lows of last August. We'll see, right? There's some uncertainty out there about, you know, just how rapid the recovery is going to be, what the policy responses will be down the road. I think by and large, we still think that, you know, rates can move higher, but we don't believe it will be, you know, violent going forward. I think, you know, to the question about how do you size up high yield relative to, say, Treasuries, it really does depend on what your portfolio income targets are, right? So, you know, if you do have, you know, a lower yield target in your portfolio, you can get comfortable with owning, you know, Treasuries, or, you know, if you're worried about inflation, you know, tips, et cetera. In high yield, I would also point out that I think if you do want that higher income target in your portfolio, you know, it's not a one-size-fits-all thing. You can pick your spots in high yield. So as an example, I mentioned, you know, we have a, you know, a factor fund, or what some people call smart beta, which this has been going on in equities for a while, but it's this idea that you screen on quality and tilt towards value. You know, as it turns out, that's working pretty well. And the idea is that, you know, you try to screen out names that are more likely to suffer defaults. That fund, I think, over the last 3 years has been a top decile performing fund by Morningstar. So there are ways to play this without just necessarily taking high yield as one size fits all.
Yeah. And what about that spread that John was talking about? If let's assume we go to 3% on the 10-year in the next, you know, year or something like that. I mean, high yield isn't going to be 4.5% if the 10-year goes to 3%, right? I mean, there's going to be. So, do you anticipate the spread widening or closing if we do see continuing creep up in yields in Treasury yields?
I think it depends exactly what you just said, whether it's a gradual increase in rates. If it's a violent increase in rates, I think risk assets across the board may not react that well, at least initially, to that. If it's a more gradual increase in rates, you know, can you see significant spread tightening in high yield from here? I mean, if you look at the historical averages, you know, we're not that far off of you know, tights. As I said before, I think this is more about the market started pricing and reopening. You know, fundamentals are kind of catching up to that. So, you know, all things equal, if you would assume that if Treasuries rise and they do so, you know, in a gradual way, that spreads will sort of keep pace with that. And then, you know, yields in high yield, of course, will go up, you know, commensurately. So,
yeah. Yeah. Isaac, I guess let me lay out the problem for the average CNBC investor that contacts me. They've been forced much more into high yield in the last 4 or 5 years, of course. So it wouldn't be unusual for somebody to say, I have 5% of my portfolio in high yield, 10% even. I see even more in some circumstances. And now they're messaging saying, okay, what does everybody think should I do with it now? Now, John's position is, on a risk-adjusted basis, it's probably not worth it to hold so much high yield, say 10%, pick a number, and maybe you should transfer into, he suggests, high dividend-paying stocks. Does that make any sense to you, Isaac, or what are you recommending here instead?
Yeah, I think when we look at those equity markets, and obviously there's outperformance periods, especially if you compare, as John did, the past decade, where it was an absolutely roaring bull market for equities. But at this point in time, when you look at high yields, you know, it isn't about decade-long periods. It's about multi-year periods for most investors. And high yields, surprisingly, usually outperform the S&P the first 3 years coming out of a recession. And you can go all the way back to the 1970s to see that average. So there is a definite exposure to high yields as these investors look for bonds as a portion of their portfolio. Problem is, like you just said, the last few years, investors have continued to flock to these assets, desperate for yields, with the 10-year, not from a real yield standpoint, not covering the delta it needed to get past inflation, and high yields did. And there's certain spots within the high yield markets where you still have relatively wide spreads. You know, if you're in energy, transportation, industrials, you have a spread range between about 570 and 628 points. If you're in communications or finance, utilities, you have that 323 to 360 or so, and that's compared to the 340 that the whole high yield market has. So I think being very specific in the areas is important, but investors are still looking for a yield. I would agree with John that investors have driven this price really far down, and it's showing significant risk right now. How much reward can you get for this yield? If rates were to rise, historically, if you saw a 1% increase in rates from here, high yields, convertibles, floating rates, those are really the only three places you can normally hide in the bond markets. But at the same time, we're dealing with a huge yield compression. And so with defaults starting to decrease, you're going to have interest rate sensitivity be a major struggle. And that default is important. I mean, if you're looking at defaults at 6.17, I would agree that they would go down substantially from here over the year as long as we get expansion. But you still have very unattractive underlyings for the yields that are being paid. I mean, look at the Tesla runs as an example. To go from a 9.5 yield to now paying out 2.3, you're talking about high-end investment-grade bond levels there. The same thing happened with Carnival. They went from a 12% yield to a 3.26, and that's with a negative 5.5 on their earnings per share. So people are giving money to this asset class, really hoping it will do something. Last year, it didn't even cover its yield. So there is pent-up opportunity in many of these different areas.
What about that? And let me just throw out to anybody who wants to. I mean, in one area I do see that's kind of risky for people is the sheer supply of debt out there. We keep reporting on secondary debt offerings in not only investment grade but high yield here. And thanks to Steve at iShares for supplying this. Total high yield debt new issuance 2020, $400 billion. Year to date, over $100 billion. Can companies cover all this debt from their cash flow, guys? Anybody want to take a crack at this? This is a concern that investors have.
Yeah, I think that's the big challenge is, it's being met easily with the bidder from the investor wanting to take exposure to this. But we've talked about for a while the zombie company mentality, and this can definitely show up in the high yields. They're getting free access to debt. They're able to roll over debt with these very, very low rates. But will they be able to generate profits that can cover this? And we think that's the challenge over the short term. And that's why high yields have really kind of gone flatlined here for a little while as they're trying to see what's real about the economy. Stocks can jump off into the future very easily. But high yields have a maturity date attached to them. They can't do that.
Yeah, Isaac or anybody, has the underlying fundamentals of these of these companies issuing high yield debt improved at all? I mean, do they have more cash flow, or are we just essentially having these zombie companies created or keep going because the Fed has essentially ring-fenced the inevitable default ratio for these?
Yeah, I mean, I'll say one thing before I pass it to the other guys. I think certain areas like energy, now having oil where it is, and we know that the average price for oil producers to be in the mid-50s to be profitable. So now you're in the 60s. I think that helps recovery rates instantly because with defaults last year, so many companies or other energy companies weren't going to be buying the lease or the equipment of a failing company. Today, they're able to. So there's still companies not able to meet costs, and they're going to go under, but others can jump in there. That will push recovery rates up. That will help out the markets. But also, when you're talking about this amount of issuance of debt, you're seeing a consolidation within high yields. As these rising stars start to move out, the ones that were fallen angels before start to move out of the junk bond space, you're getting a consolidation of what's available to you in inventory. Now, there's a lot of issuances, but you're getting a smaller group of securities to work from, and a lot of them are showing up in the triple C space that you still have to be nervous about.
Right. So, Steve, what about any other particular sectors of high yield that are vulnerable? I mean, he mentioned energy. I don't know if you want to comment on energy, but what about, I don't know, malls or something like that, real estate?
Yeah, I mean, I think the one interesting thing to point out about high yield over time, and this is actually pretty interesting, is that the overall quality of the universe, notwithstanding what's happened during the pandemic, but if you look over the past 10 odd years post financial crisis, the amount of double Bs has increased from a little over a third in I believe it was around 2007 to over 50% now. Same time, triple Cs have decreased their portion to I think the low teens from around 20% pre-crisis. So the overall health of the universe has been improving over time. I think in terms of interest coverage, that's starting to show improvement. If you look at, where we sort of troughed, it wasn't that far off of previous, compression and interest coverage, and it seems like it's starting to improve. So, again, fundamentals, you are going to need a solid handoff between the stimulus measures now and real growth. The energy sector, as was pointed out, is improving. In terms of what sectors are of concern, I mean, I think, from a fundamental standpoint, you wonder about, retailers long term, how they're kind of coping through this, and what their cash flow profiles will look like going forward. As an example, I do think it's good news that oil is above 60. It's helping those energy companies. And by the way, Bob, I think you may have pointed this out before. The energy company default rate was approaching 20%. So they were really driving a lot of the overall default rate for high yield. Same thing with recovery. Energy recoveries were quite low, which is dragging down that recovery rate to the low 20s. So it is good news that that profile is improving.
Okay.
Yeah,
John, I want to just move on very – go ahead. I
was going to say on that real
John?
estate side, it's a mix too, right? When you look at what's going on with office space, that's going to be a problem for a while. Retail is trying some new – with low rents, they're trying some new store methods and structures. Then you have residential real estate, who's doing extremely well. But with the energy prices moving up, you're now seeing lumber move towards double the price over just the last few months. And that's going to squeeze those home builders. It'll help existing home sales, but it'll be challenging in other spots. So these companies that are in the junk space, really, one piece moving affects a whole bunch of different areas for them to continue to make profitability and cash flow.
Yeah, good point. John, while I've got you here, a slightly different subject here, the Bitcoin ETF. VanEck's Bitcoin ETF was acknowledged by the SEC last week. That's important because it sets in motion a 45-day period whereby at the end of the 45 days, they either have to accept the application, reject the application, or essentially delay it for further review. Do you have any thoughts on what's going to happen? There are some people actually are very optimistic that this may be finally the year for a Bitcoin ETF. Any thoughts on this?
Yeah, I think there's a place for Bitcoin in someone's portfolio, as long as it's sized appropriately, less than 5% or so. I think there's plenty of other ETFs in the ecosystem which are much more, kind of obscure, triple levered, natural gas and whatnot, and VIX futures triple levered. So I just think it's the time for it. I think we've got the administration, and I think if you look at, who's in charge of, in terms of SEC, I think that all bodes well. So it's just a matter of time. And, I do think that it's better to have a listed pool vehicle as opposed to going on an exchange and paying tons of bid offer. So I think the time has come, and there is a place in people's portfolio for digital assets.
Yeah, I think the ecosystem is certainly more stable than it was 3 years ago. Whether it's still acceptable as some kind of medium of exchange or whether the SEC still wants to get into the business of regulating that, I'm not clear. It's certainly a more improved environment, though. I'd say this is the best chances it's ever had this year for getting through. Gentlemen, I'm going to have to leave it there. That does it for this week's ETF Edge. Thanks very much, John, Isaac, and Steve. By the way, we've asked Steve to stick around for a few minutes. I want to get a little bit more into depth into high yield and what iShares is recommending this year. And remember our ETF Edge. He'll be in our ETF Edge podcast. But remember, you can watch all of our shows on the website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.